Why do 90% of investors fail, and how can you avoid their mistakes? Today, we have a special guest, Connor from Redwood Investment Management, who manages $2.7 billion. And we will discuss how you can avoid very common investment mistakes and create a secure, safe, and profitable investment program that will work for you and your family. My name is Bryan Bourgeois. I'm CEO founder of Shorebreak Capital. Shorebreak Capital partnered with Redwood Investment Management a few years ago, and we have been very impressed with all of their capabilities that they have brought to us, and we look forward to working with them for a very long time in the future. A good analogy of investing is similar to building a house. When you build a house, you need a strong foundation. And the same is true with investment portfolios, investment construction, and investment management of those portfolios. And that's what we're going to be talking about today. And that's what Redwood focuses on, is building a sound foundation to help you achieve investment success. Let's start with, first off, what is Redwood Investment Management's general philosophy when they approach investing, and how does that benefit investors?
Great question. So Redwood's philosophy primarily centers around a word called drawdown. But not a lot of people might know what that is. And all it is just basically how much can a portfolio lose from its highest point to its lowest point. That's all drawdown is. And we actually have a trademark here at Redwood called risk first. So when we take an investment approach, we try to do it with this risk first philosophy. And that basically means that we want to have that drawdown number first and foremost in our decisions. So before we ever put a dollar to work, or before we ever select which fund or which asset class or any sort of that type of stuff, we really want to consider how much risk are we comfortable taking with this dollar. And once we understand that perspective, it allows us to help construct portfolios that are actually designed for individual people, rather than maybe say like a pension or an endowment or something that has an infinite time horizon and maybe doesn't need to have the same type of relationship with risk in their money that an individual person does.
Yeah, totally. What do you think, have you seen the biggest mistakes that investors make with regards to risk management control? And why should investors, have their primary focus as risk over a long-term period of investing? Why is that the most important thing to focus on? While most people typically focus on what's the highest, what is the stock that's going to, go up 100% next year, or what have you. That's typically what most investors focus on, and that leads them, of course, into trouble on multiple levels. Because Redwood is a very unique firm in that you are, I don't know if there's other investment management firms out there other than you guys, actually, that focus on the risk first approach. Why is that so critical to an individual investor's success for investing?
So the reason why it's so critical is a couple reasons, but what it can really boil down to is there's two really big emotions that come into play with money. The first one, and the biggest and the most powerful of all, is fear. And this is particularly when people get investing and maybe they're reaching later stages in their retirement journey, whether that's, accumulation or pre-retiree or even retiree, their money starts getting a lot more emotional to them, right? They start asking themselves the questions of, will I run out of money? Will it be enough? Will I have something to leave for my kids? How much is enough? And so because they get so emotional about it, that emotion of fear causes them to make some really intense decisions in what some would call the heat of battle, but is really just market movement. And it can cause them to make decisions that are not beneficial for their plan, right? I would say that most decisions made out of extreme fear are probably not the best. And so they'll do silly things like go to 100% cash, or they'll go into 100% fixed income, or something that is not best for their plan. And then the second emotion is greed. People oftentimes, it's always easier to want more, right? And it becomes really, really enticing when others around you maybe start talking about their winners. No one ever wants to talk about the losers, right? Everybody wants to talk about the winners. And so when you hear things like your neighbor became a millionaire off of Nvidia, or your country club friend made a bunch of money off of Bitcoin, it causes you to want to say, hey, I want that too. And so they'll actually do, instead of acting out of fear, they'll act out of greed and go way into something maybe more aggressive than they want. And they really try to chase, like you were saying earlier, that higher return, that next best thing. And both of those, what they lead to is just a portfolio that is very reactionary and not forward looking. So in other words, those decisions are usually made after the scary thing has happened, or after the run up of something has happened. And so because of that, they usually will not have the intended effect that an investor has when they make those decisions. And so that's why the risk first philosophy is so key in making all of our framing decisions and all of our investment choices, because, everything that we ask ourselves is, number one, are we comfortable with that risk that we're taking? Can we handle that downside risk? And number two, if the answer is yes, then it's great. What's a reasonable expectation for the risk I'm taking, right? We don't want to get into comparative games where we're taking different risks, but expect the same reward type of scenario.
So what I'm hearing is that it basically all comes down to confidence. If you have confidence in the manager, in your investment philosophy, in your portfolio, in the long-term prospects of the investment and the economy, you will tend to make better decisions. If you have a lack of confidence, which would lead you to an emotional decision, which can have detrimental effects on your investments, So
Absolutely.
I think that's like one of the most critical factors relating to investors is that exact confidence factors. Okay, we're building the sound infrastructure for the portfolio to be successful over the long term. Markets go up, markets go down. There's no way anyone can stop that. It's just how it works. So building a program that can weather the storms, weather the volatility, and also capture growth is paramount to achieving investment success. Redwood has been extremely successful in their portfolio management. They've had a very, very high growth rate due to their good performance and capabilities that they offer. And that's one of the main reasons why Shorebreak Capital works with Redwood to manage assets for our clients, because it is the best of the best and it gives investors full confidence in their investments, and they know exactly, what the expectations are, which leads me into Redwood's 3-step process. And the first step in that process is setting expectations. So, Connor, what do you mean by setting investor expectations?
Well, in the same theme that we've been talking about, maybe having emotional investment decisions derail plans, one of the biggest reasons that happens is just what people expect out of their money. And so the first step of the 3-step process in setting expectations is all about creating a clear level playing field with everybody that's involved. Us, you, Shorebreak, the individual clients, is like, let's get everybody on the same page and understand what we're comfortable, what risks we're comfortable taking, and what's a reasonable expectation of return given the risks that we're taking. That way people can really understand what is a reasonable experience, as opposed to maybe some of the other places out there really just try to sell on upside numbers, right? They just try to show the latest and greatest of what's happened. And then, they set that as your expectation. That's just setting you up for failure when you don't achieve that. So we really try to take an extra step, go that extra mile to make sure that everybody understands, what the risks are, what's the appropriate expectations, and that's how we're able to achieve that long-term success.
And that's a great point. I mean, if you are an investor, you have to ask yourself, what is my risk for my current portfolio? What is my growth expectations for my current portfolio? Do you even know what the possible risks are and the volatility drawdown is with the portfolio? And if you don't,
Absolutely,
it's something important to figure out as soon as possible, because without having that information, likely that you may make an emotional investment decision that is detrimental to your investments an investment
And the
plan and
scary part
higher
is, I would
retirement.
wager that most people don't know that, right? I mean,
I
would
would,
you agree?
yeah, definitely. Everyone that I talk to before they come on board with Shorebreak, they don't really have a very good idea of where they stand specifically as far as drawdown risk, the volatility of the portfolio, and the expected return. And we'll get into a little bit more detail about that later. But, Redwood does periodic analysis of both those drawdown and growth expectations, which they report, which we'll talk about at the end. So that leads me into defining drawdown risk. Can you tell us again drawdown risk is, why it's important to understand that markets do actually go down? They just don't go straight in a straight line up.
It would be nice if they did, Mo, but that's not the reality. Yeah. So drawdowns are a very real part of investing, right? Drawdown is just simply from the most recent highest peak to the next trough, how much loss has occurred. And, a better way to think about that is just how much maximum loss your portfolio has experienced over any time frame, right? A drawdown can be as short as a day, meaning it ticks down one day and then goes back up. Great, that's a very short drawdown. Other times you can have a very long drawdown, like 2008, right? Where the entire year is almost in the red. And so, different drawdowns have different characteristics, but they definitely impact the investment journey a lot. And so whether you can handle a lot of drawdown, like 2008 was comfortable for you, or maybe, having your portfolio go down even 5% freaks you out and you don't want any part of that. It's like understanding how much of that journey is right for you is so important. And that's why drawdown is such a key metric. Now, unfortunately, a lot of people will try to maybe either avoid this subject or not go into this subject because who wants to talk about losses, right? It's not fun. No one wants to lose money, right? But like you were saying, Bryan, it's part of the markets. And if we can talk about that and be upfront about that, we can have a much more successful investment journey.
Definitely. And I think just in my experience, a lot of investors think they can handle a certain drawdown. And they kind of have a general idea of like, the stock market in 2008 went down 55% on the S&P 500, right? And they're like,
right.
Oh yeah, I'm aggressive. I wanted to make, I want to be greedy. I want to make as much money as I can. But when it actually goes to that time where there is a market crash, well, that emotional, fear or flight factor kicks into your brain and it tends to lead to the fear reaction, which is to sell, which at the exact same time, you should actually be using the drawdown as an opportunity to rebalance the portfolio and dollar cost average into the market to capture that lower price valuations that exist typically for a very short period of time, by the way. So drawdowns do happen, but they tend to be very short-lived. They're painful for maybe a few weeks, maybe a few months, maybe a little longer than that, but typically they're it's not like common for, the markets to drop a significant amount and then stay at that level, for an extended period of time. I mean, markets will rebound. If the earth is going,
they've got a lot bigger problems.
Yeah, if they don't, the world's probably going to end. So if the world doesn't end, then the market's going to find a way to go back up, and you have to be positioned in the correct way to, capture that growth opportunity on the upside. That is where our partnership with Shorebreak with Redwood really makes sense, because Redwood does a rebalancing on an annual basis. Previously, I managed a hedge fund. I did my own investment management. I was a very successful investor in that. And I also can adjust the portfolios to capture these types of opportunities if I see them in a very prudent way. It's good to note that we have that drawdown expectation, but also, set your expectation. Okay, this is what I can expect. And then if that does happen, or when that does happen, this is how we're going to profit from it, benefit from it, and leverage that opportunity. So let's talk about the ranges that you guys provide. So you guys provide growth and drawdown ranges for each of your portfolios that you manage. Now, tell us about the portfolios that you do manage and how do those ranges work? I know they're different for each portfolio, but in general, what are those ranges and why is it important to, know that? And then also the other factor that's, I think, important for investors is that as you age and get closer to retirement, your portfolio typically you want your portfolio to become more conservative, less volatile, more income oriented. And with Redwood's portfolios that they offer, it's very easy to transition from an accumulator type stage to a distribution income type phase, to aggressive phase, to a more conservative phase. You can change between the investment portfolios and the different ranges that those portfolios have based on your current life situation. Like maybe certain things are going on where you want to be really conservative and you don't want a lot of volatility, or maybe the reverse is that true, where you have the opportunity and you're in a good position to take, a more aggressive approach with investing. Then we can easily change that into the specific portfolios that Redwood manages. So with the ranges that you have, you produce those how often, and what are they, and why should investors look at that as a very important factor for their investment
Absolutely.
portfolio?
Well, I think so. We produce them every single month. We update them every single month. But they play a really key role in that step one that we covered a little bit earlier, which was setting expectations, right? The reason why the ranges are so important is because so many people out there, whether it's by themselves or with an advisor, set expectation only on an upside number, right? They'll create a financial plan and they say that, hey, if we earn on average a 7% return over the next 20 years, we'll be okay. And that sounds great, right? I mean, but the problem is that you won't know that worked until 20 years later. And then if it didn't, what are you supposed to do? Right? It's 20 years have gone by. You can't really go backwards and try again, right? And so one of the key things about ranges that helps is it gives us a way. I like to call them like goalposts, essentially, right? It gives us a way to know that, are we on track? Are we within a reasonable, acceptable range of returns, both negative and positive? Are we within a range of expected returns that allows us with some confidence to know that our long-term 20-year plan or 10-year plan of that 7% is on track? Because very rarely, and I think you'll probably see this too, Brian, is like very rarely I would garner a wage that maybe ever. Have you ever seen 7.00 as an end of the year figure on someone's statement, right? I mean,
every year have the same thing. It just is not.
And then every year has the same number. It just never happens.
Never happens.
And so what are you supposed to do if you have 4% instead of 7? Do you sell out? Do you change? What do? What if you have 12%? Does that mean you're too aggressive? Does that mean we should dial it back? It's like the answer is that all of those numbers are acceptable. We just need a range of expected returns to understand what is acceptable for a given range of period. So we provide ranges so that way you have a 6-month update, meaning, hey, over your portfolio for the next 6 months, what can you expect? What's a good range of returns? So that way we know our long-term plan is on track. And that's really our whole goal there, is just to give you something that you can check in on and say, hey, I know that 7.00 isn't there, but am I within a range of expected returns? That means our long-term track is on plan. And the answer is a lot of times that you are.
Yeah, that brings me to the point where I think Redwood stands out amongst, against like all other investment managers mostly, in that you guys really do a good job of back testing the markets, the stock market, the fixed income markets. That allows you to come up with these very specific drawdown and growth expectations. Can you dive in a little bit on the approach to back testing and why that's important, and the value of that in the portfolio?
Yeah, great question, because that's a key tenet here at Redwood, is what we call the blank slate theory. And so a lot of times what's happened in the investment industry is people have just taken a portfolio and they say, hey, I need to be in the S&P and I need to be in the Ag. And they just, it's called general knowledge or accepted knowledge, right? And some of the things that don't go into that are some of the hidden risks that might be in there. And so what we do with the blank slate theory is essentially we're looking at every single asset class that somebody can invest in. And then we're looking at it historically from its very beginning origin, when that asset class was created, and every data point since. And we're looking at the drawdowns that it's experienced over that entire time frame, because we're not trying to invest based off of whatever is commonly accepted. We're trying to invest off of what is the risk associated with putting this dollar to work, right? If you put a dollar to work in the S&P 500, exactly like you said earlier, you have to be fully aware that it has gone down 55% in the past. That's not just something that you can ignore, versus, a lot of times somebody will invest in something that they think is safe, right? I think Our most recent example of that is the AGG. We have something like the AG, which is for the longest time been considered the super safe investment. And then we watch it draw down 18% in 2022. Just really shocking numbers. And so every time that we try to make an investment and build a portfolio, it's from that blank slate philosophy where it's like, hey, we don't care if it's called knives, spoons, forks, doesn't matter what it's called. What matters is how has it performed in the past? How has its risk characteristics been in the past? And what role does it play in the portfolio? And so by taking that lens and understanding all those data points, we're able to help construct those drawdown labeled and oriented portfolios.
Yeah, definitely. I know it's really impressive, all the work that you guys do with the back testing. And, when I first started talking with you guys, that was one of the things that I was very impressed with. And I think, is highly beneficial to investors. Step 2 of Redwood's investment process is pairing strategic investing, combining those two approaches for an optimal investment strategy. Can you explain a little bit and tell us what is the strategic and what is tactical investing and how that benefits investors?
Yeah, absolutely. So one of the things that people have heard of probably if they've had any sort of investment experience is that buy and hold, right? Buy and hold markets go up in the long run. And that's true. Markets should go up in the long run. Again, we're in trouble if they don't. And buy and hold can be a great, low cost method for participating in the markets. And then we call that strategic. So that's just the strategic side is buy and hold. The other side is called tactical or risk. That's the risk management side. And all we mean by tactical is that's the portion of the portfolio that if we enter a market downturn can go to cash. So instead of participating fully in the market downturn, you can actually sidestep it and go into cash or cash equivalents. Now, a lot of the times people have heard that usually you hear this debate about, oh, you have to be buy and hold, like markets always go up, it recovers, you should just stay invested. Or then there's other people that say, no, you can beat market downturns, you should only be tactical, never be, protect your assets. The reality is there's no law that says you have to be one or the other. And so because of that, we actually take that approach here at Redwood where we say, hey, buy and hold is absolutely effective and it has a place inside the portfolio. And so does risk management and tactical positions. And so we can actually blend both buy and hold with tactical risk management to create these portfolios that, yes, participate in the markets at all times, but also have the ability to sidestep the drawdowns during market downturns.
Yeah, and that just comes all down to like a rebalancing type of an approach. And
absolutely,
if you look at the data for a buy and hold only and a rebalanced portfolio, I've never seen a buy and hold portfolio outperform a portfolio that was rebalanced on a consistent basis, because that allows you to consistently buy low and sell high through that rebalancing process, which is a part of that strategic and tactical investment strategy that Connor's talking about. So you have the engineered risk budgeted portfolios that, what we talked about earlier, first talk about the risks. Now, can you tell us what engineered risk budget portfolios that you have and what do those look like? Like what are the expectations for like the drawdown risk? And maybe, obviously we don't know exactly what the growth could be, but the different objectives for your different portfolios.
So there's going to be 5 main ERB portfolios. The first one is going to be our most conservative, and this is for people that they do not want to handle a lot of risk inside their investments at all. And that one is going to be labeled the ERB 5 to 8%. So even in the name of the model, we're letting our investors know exactly how much risk we're targeting on the downside. So the goal of that portfolio would be to, in a sort of maximum drawdown scenario, be only to lose 5 to 8%. The next one up from that would be 8 to 12%. Again, now we're starting to take a little bit more risk, but still definitely more on the conservative side. 12 to 17% is the next step up. That's going to be more of your moderate, right? This is going to be a classic 60-40 blend in terms of equities and fixed income. But it's targeting 12 to 17 on the downside and definitely more towards somebody that is beginning to take that risk. The next step up is 17 to 25, which is going to be more equivalent to like a 70-30. And here you're going to look at somebody that's moderately aggressive, meaning, hey, I definitely want to focus on more returns than preservation, but I still like to know what my risk is and know that we're, managing that risk. The last one is what we call 25 to 35. And this is going to be somebody that's maybe in that accumulation stage. This one is very aggressive. It's going to be closer to an 80-20, 80 equity, 20 fixed income, targeting 25 to 35% on the downside. And while it still has tactical positions inside of it, the expectation here is that the growth in this portfolio is going to be much higher than the 5 to 8 because it's participating in that extra risk. So normally that relationship will live where the more risk you take, the higher the expected return should be.
Definitely. So yeah, I mean, that's a good point that the most aggressive portfolio that you guys manage still has roughly 20% fixed income. Whereas if you're with most any other firm and a client comes to me and shows me their statement and they are in the aggressive type realm, it's typically 99%, 98%, or 100% in equities. And, obviously that's good if those equities go up, but you don't get the rebalancing benefit if you don't have any fixed income. If you have only equities, you can't really, maximize the benefits of rebalancing and mitigate against risk and have just more balanced overall portfolio. Actually, I wanted to talk about one more thing on the step two. So Shorebreak Capital I've been investing in the investment management industry for 20 years, and we've done a lot of investing with, private institutions, non-correlated assets that are not traded directly on the stock market fully. They are a blend of some traded securities and non-traded securities, typically institutional type funds, which are usually comprised of institutional real estate holdings and institutional fixed income, secured loan, debt holdings. So Redwood introduced these non-correlated funds called interval funds into the portfolios. And those funds have the highest Sharpe ratios compared to all just general mutual funds, equities in the entire market. And a Sharpe ratio is a risk-adjusted return metric, which basically tells you, okay, if I'm going to take this much risk, I'm going to get this much return. And the Sharpe ratios for those interval funds are very, very, very good. And so they introduced these interval funds into the portfolios. These typically are income generating investments. They have very low volatility. And from all my investment experience that I have, they typically perform better than traditional fixed income corporate and government bonds. So Connor, can you tell us a little bit about those interval funds that you guys have now in the portfolios and why investors should, realize, what they are and how they benefit, benefit them?
These are, without making any broad stroke predictions, I think that one of the major changes you're going to see in the next few years just across the investment industry is this inclusion of interval funds. And the reason why is because one of the most exciting things Redwood has done in the last 24 months that we're very, very proud of and happy to partner with firms like Shorebreak on is previously these investment strategies inside interval funds. They have existed. They've existed for years, but they've existed in your former world, Brian, in hedge funds and drawdown funds. And in order to invest in those, usually somebody has to be, an accredited investor or a qualified purchaser. There's lots of paperwork. It adds K-1 tax forms, not 1099. And it's very, very cumbersome. It's very, very paper intensive. There's a lot of illiquidity in there. And one of the things that we've been able to do with this new interval fund is we can actually bring private commercial real estate debt, an extremely attractive asset class right now that has, little to no volatility with premium income on compared to the public markets. We can bring it to investors inside this model structure, inside the ERBs, because it's purchasable via ticker. So there's no minimums on it. There's no, accreditation requirements. There's no K-1s. There's none of these barriers that formerly existed inside these type of strategies exist now. And only clients that have this sort of relationship with Shorebreak and with Redwood can access that type of stuff because, it's really, really incredible how much that asset class in general, because that's the one that we added. And we're going to see a lot more coming in, how beneficial they are to the average, just investor across the nation. It's not reserved for hedge funds anymore, or these qualified purchasers and institutions. Everybody can gain access to them now, and it's going to be a new wave, and we're very, very excited about it.
Yeah, we've had tremendous success. I've been investing in these types of funds for probably 15 years now, and before moving to work with you guys, we had quite a bit of those assets. We still do. And we still have, the Redwood portfolio interval funds, but that brings me. I mean, it's still. I think you're correct, but still, even today, if you're with a major wirehouse or bank, if you're not in the private client group with $5 million to $10 million of portfolio size, you're not going to get access to this. And like Connor was saying, now they're structured as interval funds, which means they have quarterly liquidity and trade on a ticker. And previously could have been interval or completely non-traded, which you lose the ability to sell if you wanted to get out. So the current interval funds that are institutional investments within, which Connor was saying, the corporate debt market, have quarterly liquidity. So there is liquidity, which is the benefit of both worlds, because you get to have access at pretty much no minimum, and you get plugged into these very high quality, low volatility, good return assets. Yeah, it's just a win-win for,
Well, especially
everyone.
because we can add it on the model level too now, right? Previously, this thing, like you were saying, like unless you're that $5 million client at the wirehouse and, they can carve off, then you're quote unquote finally worth doing the paperwork for and like carving out a section of your portfolio for it. Now it's like, no, we can offer that high level of asset class and investment management. We can offer all of that to you with simple clicks of the button. It just makes everybody's lives
Well,
easier
they're already
and more
included in the
accessible.
portfolios, right?
Exactly. In today, I mean, think about that for a second, Brian. Is that somebody walking into Shorebreak's office can, with almost no minimums, come to you and they can get a portfolio where they have hyper clarity around the risk that they're taking on the downside. It integrates both buy and hold, low cost passive strategies with active tactical risk managed strategies. You're monitoring it for rebalancing opportunities, and they get private market access now. I mean, where else is that being offered for the type of stuff that you do? I just don't hear about it very often.
And we're one of the most competitive in fee structures as well. Our first year is 75 basis points, and thereafter is 95 basis points. So access not only to this high caliber investment portfolios and institutional investments, but at a very low cost, transparent way. Like, all our assets are custodied with Charles Schwab Institutional. You have a lot of the pieces of dedicated investment manager, Shorebreak Capital with certified financial planning, dedicated relationship manager, investment expertise, and it's combined with a very low cost structure. So
Absolutely.
for the end investor, I mean, this is like, really, that's I've been, like I said, in the business for 20 plus years now, and like my goal was to create the best investment platform for my clients.
Right.
That's possible. And this is what we have now. And this is what I believe to be the best, lowest cost program that you can really get into, be 100% confident in Shorebreak and Redwood and your investment performance over the long term, and achieve investment success. So the step 3, focus on client service and quantifying success. So what do you mean by client service, and how do you quantify success?
Absolutely. So step 3 is really kind of the bow on the whole thing. It really ties everything together. And the first part with client service is, of course, the communication that everybody is having between us and Shorebreak and their clients, and that's a big part of it. But when we say quantifying success, there is a lot of firms out there that I won't go into, but there's a lot of firms out there where they're happy to call you during the good years and say, look how much money we made. But then in bad years, you either won't hear from them at all, or their answer is, hang in there, It'll get better. Don't worry. Just hang on. Right. And so it just creates this moving target of what success is. And it's like, well, is it making money? Is it not losing that much money? What is success? And so with the Redwood risk first 3-step process, success is very clear. Success is number one, did we keep you above that stated drawdown level that you were comfortable with? You came in, we discussed what was right for you. Did we do that? And most firms won't put a hard number on themselves. It's something that Redwood does very differently, right? Is we put that 5 to 8% or 8 to 12%. And we're very, very clear about that. And then the second part of that metric is, did we stay within that range of expected returns? So are we on track for that long-term return? Well, how do we know? Number one, did you stay on track? Did you stay invested? Did we stay above that drawdown tolerance? And number two, are you within your range of expected returns? If both those things are true, we now have quantifiable ways to say that, yes, my plan is successful. I am on track. Things are going as they should, versus just a generic check-in of, we're up this quarter, so we should feel good. Well, are we up enough? Is it too much? Is it, it's always very vague. And I think sometimes people like it that way because, if you're vague enough, you can't be wrong, right?
Yeah, or they measure it against the standard benchmark, and then you guys are measuring it against your actual portfolio designations of the drawdown
Absolutely.
and growth, which is a better way to handle that. And so with those expectations, unless it's changed, I believe you guys put about somewhere around 95% probability that those expectations for both the drawdown and the growth will happen. So that back testing, all the back testing that you guys do, gives you that really high probability number to give those investors the confidence in
Exactly.
Redwood and in their own portfolio.
Exactly. We're in the world of investment management, so we can never make guarantees, right? I mean, a meteor could hit the New York Stock Exchange tomorrow, and things can always happen, right? But through a lot of rigorous math and like you said, back testing and a lot of work, we do have very high confidence intervals for those expectations.
Great. So yeah, going back to what we were talking about earlier, you guys produce a report of the expected return. You guys produce a weekly client letter and a weekly market update and a quarterly market commentary, right?
Indeed, we do.
Yeah. So all that allows investors just to really get a handle, a very quick, high-level view of what's going on with the economy, with the stock market, some of the perspectives that Redwood has, moving forward, their approach over the foreseeable future.
Well, that's step 3, right? Is sometimes people want more regular check-ins. They want to know what we're looking at. They want to know what's going on inside the market, how it's affecting their portfolio. And so we're happy to update people almost as frequently as they want. Like you said, weekly, monthly, quarterly, whatever is the right interval, we have a way to, update you about what we're looking at and what's going on.
Yeah. So we send out on a weekly basis the market update and the client market letter or the client letter. And then quarterly, we'll send out the quarterly commentary to all of our clients. So that's very helpful and lets everyone kind of be on the same page with what's going on. So Connor, thank you so much. Is there anything else that you think would be important for an individual investor that's, currently has a portfolio, maybe unsure exactly the best approach to take, the best avenue to take? Is there anything else that you would kind of wanted to discuss?
The number one advice I would just give to people is just, number one, understand your own drawdown tolerance. How much risk are you comfortable taking? And use dollars and cents, right? If you have a $100,000 portfolio, what number can you see that drop to before you get squeamish? And then number two, do you know what your current investment's maximum historical drawdown is? And if you don't, you need to call Bryan. You need to figure that out quick because, you could be setting yourself up for something that you're not really expecting.
Yeah, no, for sure. Awesome. Well, Connor, thank you so much. That was a great interview.
Thank you for having me.
I think that kind of shed a lot of light on how the market's changed and the opportunities that currently exist, because this did not exist when I started in the industry.
Right.
The markets are always changing. The strategies are always changing. And this is a very innovative new strategy that has worked out very, very well. We're very excited about it. And yeah, it's going back to, what you said too, is, an investor can only control a few things. They can't control what's going to happen to the market. They can control their asset allocation. They can control their fees. They can control a couple things, but outside of that, it's out of their control. Understanding
Absolutely.
that some things are just not in their control, and then we can do the best job we can do with all the back testing to put you in a portfolio that gives you the best expectations of what's going to happen, will lead you to, invest a successful investment program over the long term.
Couldn't have said it better myself.
Awesome, Connor. Thanks so much. And hopefully we can do this again sometime soon.
Absolutely. Thank you for having me.
All right. Thanks.